How much home can you currently afford? Basically, what the lender's looking for is a consistent 2-year history for income, looking for stability and consistency. If you're a salaried employee, it really makes things fairly simple for everybody, obviously. But if you are needing to use bonus, commission, overtime, incentive pay, if you're a part-time employee, you'll need to have a 2-year history, and your lender will use a 24-month average based off what your previous income was. Now, if you've only been receiving overtime, commission, bonus, income in the last 12 months, it's going to be very difficult to use that for a mortgage approval. Now, the other thing to consider is if you're self-employed. The lender wants to see stability. The lender wants to see that the business that you own is profitable. Even if you pay yourself a salary, you're still going to have a 2-year history because of the fact that there needs to be some sort of understanding of where the company stands. How profitable is the company? It's very difficult to do that if there hasn't been a 2-year history established yet. Basically, you're just working at getting all of your ducks in a row. The other thing that you want to consider when looking at an income approval is your unreimbursed business expenses. Most people don't even know what they are. Most people, even if they claim unreimbursed business expenses, they don't even know it until I have to call them and tell them that it'll be on your Schedule A, line 21. That's going to need to be pulled from your actual income because that is an expense that you wrote off for work expenses. For example, if you're a mechanic and your company expects you to provide your own tools, a lot of times mechanics write those things off, and it can be very costly depending on the year. I'm not a tax guy. You take the advice of your CPA by all means, but just be conscious of what those things are because it can turn out to be very costly for you when it comes time to actually get a mortgage. That's really the only time it's going to backfire on you. Obviously, everybody wants to minimize their taxes that they pay. Same thing applies for being a self-employed borrower. Not all self-employed borrowers show a ton of income just because there's so many write-offs, so many expenses to take into account. But the lender is not going to use your gross income. The lender uses your net income. So after all expenses, after all write-offs, what is your adjusted gross income? Here's what it looks like when I have to give somebody a call to let them know that, hey, your taxes don't show what you thought that they showed. Here's what folks always tell me when I have to tell them that, hey, there's some unreimbursed business expenses that are on your tax returns that really offset your income in a negative way for mortgage approval. Here's what it looks like when we go to verify somebody's employment before closing and they actually quit their job recently. So how much can you afford? Let's look at a quick scenario, a realistic scenario. Let's say you make $3,000 a month and your bonus income is $1,000 a month, but you've only been receiving that bonus income for, let's say, 12 months. Obviously, like I mentioned, you're not going to be able to use that on a mortgage approval. It's great that you have it, it's extra income for you, but the lender's not going to consider it because you haven't been receiving it for 24 months. So you have $3,000 a month, your spouse has $2,500 a month in income, and you're looking to buy a $200,000 home. Your other monthly expenses that show on your credit report, let's say, are $200 for a car, $250 a month for another car, $350 a month for student loans, and maybe another $150 a month for credit card bills. So with those expenses, you're looking at about $950 a month in other monthly expenses that show on your credit. Let's say you're buying a $200,000 home, you put 5% down, and you're looking at a $190,000 mortgage. With taxes, insurance, PMI, which is mortgage insurance, you're looking at a payment of roughly $1,400, give or take, depending on taxes and insurance. So with $950 a month in other monthly expenses, cars, credit cards, student loans, and then a $1,400 a month mortgage payment, you're looking at $2,350 for total monthly expenses. You take $2,350 divided by $5,500, which is your income, that's about 43% debt to income ratio. So when looking at buying a home, you always want to try to make sure you're at least 45% or below for debt to income ratio. The main objective is to keep it simple, keep it smooth. So how much can you afford? The main thing we have to do is look at how much monthly debt you have, how much your income is, and figure out what is a comfortable level for you. Not all people are going to be even comfortable going up to 45% debt to income ratio, of course, and that's perfectly fine. You need to do what's best for you and your family, but from a lending standpoint, we're going to look at your adjusted gross income on your tax returns and how much other monthly debt that you have. So again, what's the name of the game with all of this? Consistency and stability. We need to make sure that everything makes sense. We're going to use what you show Uncle Sam. So if your tax returns don't line up with what you think you make, realign your goals. Thanks again. We'll see you next time on how to get a mortgage without losing your mind.